This is a continuation from the previous video where we looked at about 10 transactions and we compared some transactions as well to make some intuitive sense of how the transactions are written in the book called Journal. In this video, we're going to look at another 10 transactions and write journal entries for them. Transaction 11 is paid salaries to staff. So salaries represents the right of the business over the use of the services of the staff. Salaries account is one account which is involved, and salaries have been paid. Typically salaries come in your bank account through company's bank account. So these are the two accounts involved here. Salaries are an expense for the business, and it's a nominal account. You debit all expenses. The bank, on the other hand, is an asset. It's a real account, and you credit what goes out. So the journal entry is salaries account debit to bank account. Okay, so 10,000. Let me use the concepts of claims of business here and try to again tell you how this transaction is affecting the claims of business. Salaries represent the claim of business over the use of services of the staff, services of employees. When you pay salaries, you have an increase in the rights. So in this case, rights are going up, which means a debit should be given. Debit represents the increase in the claims of the business. Therefore, salaries account is being credited. Let me again re-emphasize, salaries and the cash being paid for salaries are two different things. Typically, you would confuse yourself by thinking, hey, salaries is an expense, it's going out, why are you debiting it? How is it increasing the claim? So I want you to segregate the two things that are getting mixed up in your mind. The two things are salaries and the cash being paid for the salaries, right? So that's what we have done here. Two sides of the same coin. What is going out of the business is the bank balance. You are paying, the business is paying through its bank account. So this represents the reduction in claims of business over on the cash that the business has or the bank balance that the business has. So usually we mix these two. That is, in the common parlance, that's how things are thought of. But in accounting, since it is a language and we are learning the double entry system, we look at a transaction from two sides. So here are the two sides. Salaries represents the claim of the business. The bank account represents what is going out of the business in this transaction. Let's look at transaction 12 now. Goods given away as charity. All right, this is something new. This is something which we've not discussed before. Goods given away as charity. So there is a charity account and there has to be a goods account. Okay, and we know there is no goods account, so I'll clarify that also. So what is charity really? Charity is you get people walking in, NGOs coming in saying please donate money, or in kind you could deliver, you could donate goods. So rather than giving out money as donation, this business has given goods. For example, let's say this is a furniture trading business. You purchased goods, purchased furniture. You're trading, not manufacturing. You purchase furniture, you sell furniture. You have purchased the furniture. So let me just draw it out here. You purchase a stock of furniture, 100 units, and then you intend to sell these. However, during the financial year, somebody comes to you, say, do you want to donate? And you say, okay, I don't want to donate cash, but if your office, if the office of this NGO or some organization need some tables and chairs, I could supply that. So you give them 5 units of furniture, but you don't charge them, so money is not coming in here. Therefore, you are left with the remaining 95 to be sold. And it is possible that you sell only 90 units and remaining 5 units are your closing stock. So this is charity and this is unsold stock, which is also called closing stock. I introduced you to a new term here. We'll talk about closing stock more later. So we're talking about these 5 units which are being given away as charity. So when you give away goods as charity, the goods go out of the business. So you have to do something about that. And we know the goods which are going out, they are going out from which account? Purchase account. Because purchase account represents the goods that come into the business. Goods come into the business through purchase account, they go out of the business through sale account. However, sale is not happening here. Therefore, you're going to use purchase account to indicate that the goods have been given away. It will become more clear in a few seconds. Therefore, instead of goods account, I am going to use a purchase account. Purchase account. It represents my goods account. Charity is the name of the expense, that is you're giving away goods instead of cash, but the goods were purchased by paying for them in cash. So the 100 units were purchased at, let's say, rupee 10 per unit. Therefore, the 5 units being given away, you have paid 10 rupee for them to the vendor from whom you purchased it. So the value of the goods which are being given away is 50. So 50 is the charity that you do. It's an expense, it's a loss in a way. However, charity is also thought of a kind of advertisement for the business. So you consider it as an expense. So charity account is going to be representing the expense or the loss for the business. Expense slash loss for the business, and the purchase account on the other hand represents your goods. So you are think of these only as goods, although we know purchase is also considered an expense account. I can also use this logic to explain to you. Let's move forward with this. Since charity is an expense and purchase is also an expense, what both the accounts are nominal accounts. And in nominal account, you debit all expenses. The new expense that you are creating through this transaction, the name of that expense is charity. So I am going to write charity account debit. Okay. Now, typically you pay for expenses and you write bank account, cash account. Okay. And if you don't pay, you write the name of the vendor because a liability has been created. However, in this case, a unique thing is happening, which is you are giving away goods. So instead of paying in cash, you are giving away goods from the purchase account. I'm going to write purchase account to purchase account or purchase account credit. Now, you would say it is also a nominal account and purchase is an expense, so you should debit all expenses. However, that is what is unique about this transaction, a slightly more complex transaction where you are not following this rule. Rather, what you are doing is an adjustment. What is the adjustment that you're doing? Well, let me bring here the journal entry from a purchase transaction. Let me go back to the purchase transaction. So we had transaction number 2 where you purchase goods from your vendor and the journal entry is purchase debit to your vendor. So let's go to transaction 12 now. Purchase account debit to your vendor whose name is Madanlar. This was transaction 2. So let's say you had bought these 100 units from Madanlar in the beginning, and in the purchase account you wrote those 100 units here. All right. Now you would consider the purchase as an expense. However, all the purchase is not being sold. So in the purchase account, as we have discussed, you only consider the units which are being sold during the year. So some units, 5 units, are being given away as charity, 5 units and 5 units. So we are doing in this transaction here is adjusting the number of unit in the purchase account. We are saying although we purchased these goods, we did not resell them. The purpose was different. We gave them away as charity. So our purchase should reduce by 5 unit. We should not be showing purchase of 100 units as an expense when we do our profit calculation. We should clearly state that only 95 units were available for resale and 5 units have been given away as charity. So what we are doing here is we are converting 5 units from the purchase account to a new account called charity. Think of this as a channel, a pipeline. So from purchase account you brought 5 units here and then you converted them into charity, right? That is what is happening. So net effect is in the purchase account you'll only have 95 units, which is the correct way of showing it. And here the reason for giving a credit to the purchase account is because we had a debit of 100 unit to purchase. We created an opposite, a cancelling transaction for purchase account by writing to purchase account by giving a credit to the purchase account. Therefore, so that the purchase account shows only 95 units. And then after bringing it here, after cancelling it from the purchase account, we are then indicating that these 5 units are being given away as charity, and that is the actual expense of the business. Okay, I think it is getting a little complex, but there are more transactions of similar nature which will clarify these things more. So let's move forward. Okay, next up is bad debts written off. We have discussed earlier what bad debts are, but let me quickly take you through this journey. So first of all, you sell goods to a customer. So the transaction is customer's account debit, to sale. So let us say this was 100 and this was 100. Now customer is your debtor, so it's the asset account which we are talking about here. Then the customer pays you back. So when customer pays you back, you write bank account debit to the customer account. So let us say he paid you 90. Okay, and after this you realize that you have new information that the customer has gone insolvent, he's gone out of business, and he's not going to be able to pay you the rest of the money. He has already paid you 90. The effect of transaction 1 and sample transaction 1 and 2 here is as follows. You gave a debit to the customer by 100, which meant customer owed you 100. Then you gave a credit to the customer by 90, which means you deducted 90 out of this 100. Therefore, what the remaining balance is in the customer account debit is only 100. This is the balance. Since this is a debit, and 10 is this is a debit, it represents the value of the asset which is remaining. So 10 is what is to be recovered. This transaction 13 says now it's a bad debt. So this money is not going to be recovered. If this money is not going to be recovered, it is for sure. Then you have to write it off, meaning you have to remove it from the books of accounts. You should not show this balance as an asset. So right now this is showing this is a current asset. You expect to recover this money, but new information is you can't recover it. And now I'm invoking the principle of conservatism, which says, report your losses. Report your losses as soon as you know about these. Be conservative about these things. Do not inflate your profit. So if you have new information, now you have to cancel this asset. How do you cancel this asset? You create an opposite transaction. there is a debit of there is a balance on the debit of the customer account, you give it a credit by same amount. So you're going to say to customer account, to customer account. So you are giving a credit to the customer's account. By doing that, you are cancelling the debit which was left over. The amount here is 500, that's why I'm writing it as 500. So the question is, what should be the other account which is involved? You are cancelling an asset. You expected to recover this money. Now you're not going to recover this money. It's clearly a loss for the business. So you have to write the name of the loss. Name of the loss is bad debt. Bad debtor. Okay, bad debt account debit 500. Okay, so if we were to go, step by step, I would first write bad debt account. This is one of the accounts. The other account is the customer from whom this money was expected to be recovered. So in customer's account, since you want to cancel it, you will create a credit transaction in customer's account, and that's what is done here. And bad debt is a loss that you are recognizing in the business, and all losses are nominal account, and you debit all expenses and losses. That's what has been done here. So that's how you would do it step by step. But I wanted you to understand why customer's account is being credited, because in this case, this customer account, which is, if you think more about it, this was a current asset, and now it is no longer a current asset. It is a real account. The asset is going out, so debit what comes in and credit what goes out. You could use that logic as well. However, you need some explanation to see it through in this way. All right, let's move to transaction 14. Okay, suddenly what has happened is bad debts have been recovered. You earlier have written off the bad debts, but suddenly the customer comes up and says, hey, I made some money and I can pay you 300. Do you want to take the money? Of course you want to take the money. So cash account is involved because you receive cash from the customer. So cash account is a real account coming in. It's an asset. Debit what comes in. So cash account debit. Now what should be the other account? You have bad debts recovered. Bad debts recovered account, which is a gain. You recovered the money, or this is a nominal account. All incomes and gains are nominal, and you credit all incomes and gains. Therefore, you're going to write to bad debts recovered account. So cash has been received. You write cash account debit to bad debts recovered account. All right, let's do transaction number 15. Carriage paid on machinery and expenses. This is an expense on purchase of asset. The amount is 1,000. All right. Carriage is simply a transportation. You purchased the machinery and now you have to bring it to your site, the plant where the machinery will be operated. So you have to pay some transportation cost. So the reason this text has been given here, expenses on purchase of asset, the reason is that any expenses on the purchase of the asset, shipping cost, installation, all of that is added in the cost of machinery, in the cost of asset. Okay. So until the time the asset is ready to be used, all the expenses are added in the cost of the asset. For example, people who own car, when you go to the showroom, they tell you a showroom price, and then there is an on-road price, which also includes insurance that you have to pay. You have to get the registration as well, and some accessories have to be installed on the car. So there is a price which is in the showroom, and then there is an on-road price. In fact, there is another ex-showroom price as well. But the idea is that there are the cost when you say what is the price of the car when your friend asks you, you quote the final price, right? On road, this is how much it cost me because that also went out of my pocket, and the reason is I bought the car. So everything has all the expenses have to be added to that. My final expense is this much. So this is what is similar logic here as well. So carriage being paid is an expense. So let me write carriage account. The other account involved is machinery account because it's being paid on machinery, and you are paying it in cash. So cash account. You are paying it in cash, certainly cash is involved. Out of these two, we have to identify one. And I just mentioned that we do not consider this as a separate expense. We add this cost to the cost of the asset. That's it. So if the machinery was bought for 10,000, now its value is going to be 11,000 because you paid transportation on it. Any expenses pre-installation is added to the cost. Therefore, not the carriage account but the machinery account is going to be involved. Both these accounts represent assets and hence are real account. What is coming in is machinery. So you write machinery account debit and you're paying cash for it. So cash account to cash account, not cash account credit by amount of 1,000. Typically you would be given the value of machinery as well. So you can write the amount as 11,000 instead. Alright, let's move forward. Depreciation on fixed assets. I have explained the concept of depreciation before. It is reduction in the value of fixed asset over a period of time. So financial year 1, financial year 2 and so on, financial year N, you purchase an asset, let us say here fixed asset for 100, you use it for 1 year, its value goes down by 10, the new book value is 90. Like this, the reduction in the value of the asset every year. So what are the accounts involved? Now the fixed asset, if we had the name of the asset, we would write that. Fixed asset account is certainly involved because its value is going down due to depreciation, which means that an asset is going out of the business, or the value, the asset, asset is going out of the business equal to value of the depreciation. The other account involved is depreciation. Depreciation is regarded as an expense. It's an operating expense of the business. Let me clarify that as well. Depreciation, I think I've done that before. This is an operating expense of the business. While doing the calculation of profit for the year, you deduct depreciation. Also, depreciation does not involve cash. This is a non-cash expense. All right, and accounting is done on accrual basis, not cash basis. So if you are thinking, if it is not a cash transaction, why are we recording this in the books of accounts? I'm invoking the principle of money measurement here, generally accepted accounting principle. Anything which can be expressed in terms of money can be recorded in the books of accounts. So the question is, can you measure depreciation in monetary terms? Yes, you can. In fact, there are rules around it. There is an accounting standard, which I think accounting standard 6, it talks about the depreciation rates for different types of assets. So there are rules around it. There are rules around how to measure depreciation in monetary value. So this is done, depreciation being an expense, you gonna debit it. This is a nominal account. All right. The transaction is going to be fixed asset going out credit. So you're going to write to fixed asset, and you have depreciation as an expense. You debit all expenses. So you're going to write depreciation. depreciation account debit 500. All right. Now I want to do another working note here, just to make it more intuitive. You would have purchased the fixed asset before. When you purchase the fixed asset, what is the journal entry? You debit fixed asset account. This is a sample. Fixed asset account is debit and you pay for it, so to bank account. All right. Let's say this is 1000 and this is 1000. I don't have space, otherwise I would stagger it and write it towards the right hand side. When you purchase fixed asset, you give it a debit. You say the claim of the business on the fixed asset is worth 100, is going up and it is worth 1000. Now depreciation is being charged and fixed asset is being given a credit. Now these are counter transactions. This transaction is cancelling this transaction. This credit is cancelling this debit. However, debit was equal to 1000, credit is equal to 500 only. Therefore, there is a debit balance. There is a balance in the fixed asset equal to 500. Meaning, the value of the fixed asset went down from 1000 to 500 now. So, if you look at the notebook where you maintain records for the fixed asset, you will see 1000 it was purchased minus 500. The value currently is 500. So this is going to be summarized in the notebook or in the journal where you write transactions for fixed asset. So this is the net effect of the transaction. Another thing that I want to indicate to you, what you are really doing is you are leaking the value of this asset here, okay, and then you are transferring this value into depreciation. See what I'm saying here? Value of the fixed asset is shown as an expense in this year. Some value. So 50% of the value, let's say, is going into expense. Likewise, every year you spend the value of the fixed asset in terms of depreciation. You actually pay for the asset right in the beginning when you purchase the fixed asset. However, you show it as an expense in smaller parts every year, for the duration of the life of the fixed asset. More on depreciation will be done. More discussion will be done in some of the future videos. But for now, this is sufficient. Let's move forward. Carriage paid on behalf of the buyer. What does it mean? Carriage again is a transportation cost. There is a buyer, which is your customer. You would have sold him some goods, and when you deliver the goods, you would have paid for transportation, but the customer should have paid for transactions. So now you have to recover this money from the customer, right? That is what is happening in this transaction. So there are three. What are the accounts involved? So there is carriage account, which is the transportation cost. There is a customer which is involved, customer's account, and you paid the carriage. So I'm going to use bank account. All right. So clearly you paid for it. So bank account is involved, which means there is going to be only one out of these two accounts. Should this be carriage account or a customer account? Carriage account means it's an expense account. Whenever you start an expense account, you are going to take that expense to the calculation of profit finally. So if you open a carriage account, it would mean that business has an expense named carriage. However, this is not business's expense, this is customer's expense. You paid it on customer's behalf and you will recover it from him. So you should certainly not open a carriage account, otherwise it will show as business's expense. So what you should rather do is you should say I have to recover this money from the customer. So you should use customer's account. Make customer a debtor. You have to recover money from him, make him a receivable. Therefore, if this person is going to become a debtor, this will become an asset for you and hence the real account. So debit what comes in. A new customer, a new debtor is being created. So I'm going to write the customer's account or the buyer's account, customer's account debit, and if I had the name of the customer, I would write his name. To bank account, and there you go. If it was a business transaction, you would write carriage account debit to bank. Customer would not come into picture, and this carriage account will be taken to calculation of the profit. Matching principle. You have to match expenses of the current year. But this expense is not business's expense. Therefore, we are not writing carriage here. Instead, we are paying the money on behalf of customer. So we are creating a recoverable. We are creating a claim of the business. Claim of the business on customer. We have to recover from him. This would have been a claim of business. Claim of business on the transportation service. We could use that service. So, we're just exchanging it. That's not the case. If this was a business expense, we would write this. All right, let me stop here, and there are more general entries on the other side. I'll see you in the next video.